There are a lot of jitters right now. And I think a lot of it has to do with psychologically the fact that now markets are very confident that the Fed is going to cut. Um, Bad news becomes bad news. You've heard it before, but it really is true. And so any signs that this economy is weakening more than we had initially thought is cause for a sell-off, especially among stocks that are more closely priced for perfection. And that really is the story that we saw yesterday, and we may very well see it again today.
So it's a bad news is bad news situation when it comes to economic data and then the equity market, but it's still a slowing, not a downturn, right? So I'm trying to understand the distinction then when we do have some sort of big equity move.
Well, it is a slowing, but keep in mind, we don't exactly know how this monetary policy tightening plays out because of the long, variable, lagged effects of monetary policy. And so that is the underlying fear that gives markets pause and jitters when we do get, for example, a disappointing manufacturing PMI, or we see earnings warnings from companies or whatever the case may be. So I think that right now markets are walking on eggshells. And we could very well see this leading up to the Fed's meeting and again as we lead up to the election. So this should be, I think, a more volatile fall, one where there's more downside potential. But I think ultimately we end 6 months after the start of easing. I think we end in a better place because that is an environment that's supportive of risk assets.